Empezamos entonces. Ahí está. Well, hello everyone. We are so happy to have Linda Tesar as our keynote speaker today. We have known Linda for a long time, so I will be short. But Linda received her PhD from the University of Rochester, and she's currently a professor of economics at the Department of Economics at the University of Michigan. Linda's presentation today is titled A North-South Model of Structural Change and Growth. Thank you so much, Linda, for being here today. We are really happy. The floor is yours.
Great. Thank you so much. I'm going to share my screen so that you can see my slides. I think this is where they are. There we are. Very good.
Yeah.
Can everyone see them all right? And I'm going to move this over so it's not blocking. So when I answer questions, I'm probably going to be looking away from the camera. So don't let that disturb you. I also want to say I'm just so delighted to be here. I had looked forward to coming to this conference a year ago. We thought we could all get together then, and then it got postponed. And then I was delighted to be able to come again. And of course, here we are still sitting, dealing with the COVID virus and doing everything by Zoom. So we do what we can. I'm delighted to have the opportunity to talk with you today. I also want to say, well, I hope I can be invited again when I actually can come and enjoy being in Chile, but we'll save that to the future. I also want to say that I do better when I'm interrupted, actually. So feel free to ask questions as we go along. I'm going to be talking about a paper that I've been working on with a couple of my colleagues, and it is work in progress. And so we are very happy to get comments and reactions from the places we present. So please, by all means, if something doesn't make sense or you have a comment, just send something to the chat or the Q&A, and they'll bring it to my attention. So with that, I'll get started. This is a project, as I said, I've been working on with my colleague, John Leahy at Michigan, and with my other colleague, Maria Aristizabal Ramirez, who is a graduate student at Michigan. This is her last year. She's working on her job market paper. This is not her job market paper. She has another paper that she'll take on the job market, but keep your eyes open if you are looking for an excellent macroeconomist, because Maria would be fantastic. So this is a paper on growth, thinking about growth and structural change from an overall global perspective. And I want to say from the beginning that what we're really doing is taking ingredients and taking facts that I think are probably known, but we're putting them together to try and make them all kind of reconcile together, and then to set up a framework where we can think about what are the impacts of globalization and sequential globalization. So that's where we're headed with this project. Now, why wouldn't it let me go forward? Oh, there we go. There we go. Okay. So just by way of motivation, in the 1990s, there were a set of liberalizations that happened. Economies opened their financial markets to allow capital flows. This was in response to the debt crisis of the 1980s, and there was a movement to liberalize markets to promote growth and increase access to financial markets. For some of you, probably for most of you, this is economic history. For me, I was kind of living part of this, and one of the people I was commenting on what might be the impact of this kind of Washington consensus set of reforms that kind of affected much of Asia and Latin America. And, you know, even though this happened some decades ago, the impact of the reforms are still a matter of debate. In fact, there's an issue of the Journal of Economic Perspectives this summer that has a set of articles that looks at different regions around the world and looks at different proponents or those that aren't proponents of this liberalization. And so there's a set of articles there. So this continues the impact of that set of policies. And I think critics point to, this set of reforms happened and they failed to produce sustained growth. It looks like the sequencing of reforms really mattered, and that those that came, Roderick has an argument that those that came later to the process of liberalization found a set of prices and a set of made it even harder for them to grow. On the other hand, proponents argue that, well, no, actually, the impact of liberalization looks a lot like what we expected to see in a neoclassical world, that liberalization generated surges in investment and a decline in the cost of capital. So what I'm going to do today is say, really, both sides have some truth. At least look at this very high level. Of course, we know there were crises. We know there were lots of other complications that came along. But from the perspective of long-run growth and structural change, I think both points of view that it didn't really change the long-run growth trajectories, but at the same time did lead to surges in investment and changes in the cost of capital, that all of that can be reconciled in a model that captures features of long-run growth and structural change. So that's what I'm going to be talking about today. And I'm going to start by documenting some facts about investment, income, and structural change in a large set of countries that span 6 decades of data. And then we're going to summarize what we take from the data as kind of the facts that we want to capture in a model. We're going to develop then a 2-region model of the world economy. And this version of the world that we will have in this model is that each region is following its growth trajectory, but they start with different initial conditions. And I'm going to try to convince you that that's pretty good, actually, for thinking about, on average, what was true about economic growth and development over the last 6 decades. Then at some point, the 1990s, these economies opened and private capital flows moved from one region to another. This led to a reallocation of capital. This led to changes in investment, and it also shifted where countries were on their process of structural change. So I'm going to try to convince you that that's what the data look like, and then this framework will allow us to do some counterfactuals, where we can ask questions like, what are the welfare effects of capital market liberalization? Does it matter if you go early or you go late? And what happens with subsequent liberalizations? And we're going to take opening with China to be the next wave of liberalization and ask, given the conditions that countries have when that happens, does that affect the gains from liberalization with China? So I'll get into all those details when I get there, but that's the big roadmap. So I don't want to go into a lot of detail about papers, but just to say, obviously, many, many, many very, very smart people have worked on growth and structural change. Some papers focus on kind of a supply side story, different factor intensities, and that as growth happens, you get this structural transformation. Other people focus on, no, it's shifting demand, but as income rises, we have different tastes for services versus manufactured goods, and that's really the driver of structural change. There's a lot of models that have openness and growth. We're going to have all of this. We're going to be combining all these ingredients. We're going to have an open economy model after liberalization. We're going to show that the supply side of the model drives these investment humps, this increase in investment and then a leveling off and a decline, whereas the income effects are really going to be important for structural change. But it's all those ingredients are going to be in the model. Okay, so I'm going to start with data. That's the most fun part anyway, I think. So we have 34 countries, which accounted for over 80% of world GDP and about that same fraction of investment. So it really was the world economy as of 1960. We're going to take this set of countries and divide them into 2 groups. And the cutoff point for those groups is going to be median per capita income as of 1950. So at that point in time, who was rich, who was not rich? And put them into block A, the ones that were above median, and block B, those that were below median. Now, the one exception that I want to point out is Japan, because just very low, and then grows quickly, and in kind of a short order looks a lot more like the Block A country. So that's the one country that we don't use this median income cutoff, but we move them into Block A. So now I'm going to show you a bunch of pictures now that I've divided these countries up, just what we think are some interesting facts about investment and structural change. So first, I'm going to showing the trajectory of investment rates over time and across countries. So I'm plotting investment as a share of GDP relative to log real per capita GDP. As time goes on, you're going to see we're going to shift over to the right, and we're going to kind of trace out as income grows what's happening to investment rates. Now, this is for Block A. And each dot in this figure is a country year. And the darkest dots are the final year of that decade. So I'm going to do it by decades. So this is for the 1950s, with 1960 being the darkest dot. And as we move forward, so here we've got the 1960s to the 1970s, to the 1980s, to the 1990s, the early 2000s, to the 2010s, to the final set of observations. You can see that this sweeps out. Now, it's not perfect, right? They don't all line up on the parabola, but it does create a parabola and a sweep of data as it moves to the right. So that's what we're going to describe as these hump-shaped patterns in investment that sometime at some level of per capita income and then seem to decline after that. By the way, this is true when you look at individual countries as well, that you see this hump-shaped pattern. And we're not the first to point this out. We're just trying to incorporate this in a model of open economy with range. Okay, I can do the same thing for Block B. And here you're going to see these are throughout the presentation. I'm going to try to do Block B in red and Block A in blue, just so we can kind of keep the facts. So here you see, this is the Block B region. And again, you see these points trace out to the right. It's a bit noisier. These are economies with more volatility. There's crises in here. We haven't taken anything out. This is just the raw data. So you can see that they shift to the right with a little more volatility. But again, you see this hump-shaped pattern in investment. Now, if we take that data and we just take the average for a given year. So now this is plotting annual data for each block. Again, the red is Block B and the blue is Block A. And you see it forms these two parabolas. They really have a very similar shape. And the key difference, they peak at essentially the same investment rate. It's just that Block B peaks at a lower rate of per capita income. So that's kind of interesting. It looks like an identical investment pattern, but peaking at an earlier investment rate. We can also plot this in terms of time, and not surprisingly, since income tends to go up generally with time, you get, again, a similar investment trajectory, this investment peak. They peak at about the same rate or at the same level, but you see that now Block B peaks at a later point in time, Block B peaks earlier in time. And we're going to want a model that can capture those simultaneous investment trajectories. Indeed, if we take a time shift of 17 years and we say, just plot them on top of each other, it looks like Block B essentially has the same curve, only it's peaking 17 years later than Block A. All right, so we think this is suggestive that countries are following similar growth paths. They're just growing, starting at different points in time. And if we look at those parabolas and we estimate the parabolas, we can't reject that they're the same. And we see this difference in the year at which they peak. And we see that they peak at different per capita incomes, but they peak at a very similar investment rate. So that's what we see in terms of these investment humps. I also, because I'm giving a talk virtually in Chile, I thought I would just put up some data to highlight individual countries in Latin America. So I've added here Argentina, Brazil, Mexico, and Chile, as well as the aggregate investment curve for Block B. You can see that for most countries, the data also exhibit this hump shape, except for Chile. Now I know some unique things were going on in Chile in the 70s that really depressed investment. Yeah.
Yeah, David Kohn, he's asking if those ratios are nominal aggregates. And he also asked if could there be a price effect because of the fact that PK, price of capital over investment, decreasing over time due to productivity improvements?
It could. So this is, I want to say, this is nominal investment over nominal GDP. So that's a very good point. And I should, I think we've also looked at adjustments for the price of capital, but I don't have that here. We've thought about that. It doesn't really change the picture, but I appreciate the point. And this is nominal investment over nominal GDP. So there could be some, if we think that the price of capital is different, that could affect things a bit. Now, one other thing I want to point out for Latin America, I've grouped Asia and Latin America together. And generally, it's true that the investment rates are higher in Asia and they're somewhat lower in Latin America. So the average comes out to similar to Block A, but I do want to note, be transparent that there are differences across the two regions. And it could be an interesting thing to pursue further. I'm not going to pursue it today, but it could be an interesting thing to pursue down the line. Okay, so the other thing we look at is structural transformation. So this is now plotting for both Block A and Block B, what's happened to the shares of agriculture, which are in green, manufacturing in red, and services in blue. And starting with Block A, what you see is kind of, again, this is a fact we all kind of know, so we're not presenting new data here. But what you see is that, gradually advanced economies are switching out of agricultural products. There's sort of this hump shape in manufacturing that kind of maps up a bit with that hump shape in investment. So that's going to affect how we think of modeling this. And you see this shift into services over time. Over here for Block B, you see the same pattern overall, but you see that the services share starts much lower, agricultural share starts much higher. And again, this is suggestive that it's a similar growth process, but it's starting later in time. I highlighted here these sectoral shares for 1995 to the end of the sample for Block B, and the earlier sample for Block A. And it turns out if you look at those two eras, I forgot. And I also put up Latin America and Chile, similar pattern, a little more volatility, but similar pattern of structural transformation. No surprise there. Now I'm going to take those two shaded regions and plot them on top of each other. So if we take a time shift now of 35 years, it looks like where structural transformation in Block B is very similar to where structural transformation was 35 years ago in Block A. So this is going to motivate us to think about, there's also a time shift in terms of this process of structural change. Doesn't line up exactly with the process of structural change, or the process of the time shift in these investment rates. Okay. The fourth fact that's going to be part of what we take to the model is that we see this surge in capital flows that not surprisingly occur around that time of capital market liberalizations. So this is private capital flows from Block A countries to Block B countries. And you see this increase in some total capital inflow into Block B of about 4% of GDP that kind of declines over time. We also see this later surge. We're really going to be focusing on this initial surge of capital flow. So we want our model to match up with that. And as you know, there were we're going to time this around the set of liberalizations that occurred across Latin America and Asia. And one thing we see, and this is the final fact, and then I'll get into the model. One of the things we see is that this stage of this date of liberalization does seem to affect this investment parabola. So if we fit the data, the dotted lines are data fit up to the point prior to 1990. So we get the same parabola if we look at the data pre-liberalization. If we add the data after liberalization, after 1990, that investment curve, particularly for Block B, shifts up, suggesting that there really was a perturbation in investment rates and a persistent perturbation that affected Block B countries. Now, obviously, this is an average. I'm showing you the pretty smooth figure. There's a lot of dots all around that. But generally, this does suggest there's an upward shift in that investment rate. Okay, and Latin America, again, the same sort of thing. If we fit to pre-90, we get the same shaped hump, but we get, I'm sorry, this is the same shape. And then we get kind of a tilting up when there's liberalization, so suggesting that investment rates went up. And again, showing you that the investment rates are lower in Latin America than they are for the kind of the Block B average. Okay, so those are our facts. We see this hump-shaped pattern in investment to GDP. We see that Block B peaks later in time and at a lower level of per capita income. We see a pattern of structural change that looks quite similar between Block A and Block B, although it does have this time shift. It's happening quite a bit later in Block B than in Block A. We see this surge in private capital flows from A to B that happens after 1990. And then we see that this does seem to affect investment rates after 1990. So we want to take this to a model, and we want the model to kind of look like this, and then we can use that model to go back and look at other data.
Linda?
Yeah.
Hi, I have a question. So I'm pretty ignorant about the history of liberalization in the countries you showed just before.
Yes.
Is this, because investment, is a long-term thing, it reacts to expectations. Is this like a build-up, we're going to liberalize and therefore it sort of, investment can react in advance, or how does this fit into the idea of the investment is a...
So we're really taking this, I am sure to some extent, good point. I'm sure to some extent, the set of policy reforms, there were a bunch of them, right? There were fiscal reforms, there was inflation stabilization, there was different kinds of legal reforms. We're focusing more specifically on the capital market liberalization component. So you might think that other parts of the reforms could have made the investment climate more favorable and might have occurred prior to the inflow of capital. I think that's fair. Most of what we're doing is very much kind of smooth, long run, looking at decade averages. So I don't think it's the exact timing of these things is going to matter. I guess I would say that the reforms that made it a favorable climate, along with the capital market liberalization that allowed for foreign ownership, probably together encouraged the surge in investment. And we are approximately picking that up around the early to mid 1990s. And in fact, we put some adjustment costs in, you'll see, because obviously it takes a while for investment to adjust. So it isn't like it happens immediately, and it doesn't happen immediately in the model. Does that answer your question?
Yes, thanks.
Okay, so I'm going to do kind of an overview of the model, because I have to say, I don't think there's anything more boring than looking at models on Zoom. That's my own preference. But maybe the next most boring thing is talking about models on Zoom. So I'm going to do this in and also it's a fairly standard setup. So I don't think I need to really belabor the point. So I'm going to describe it. We're going to have one slide with equations, and I can explain, I think, everything with that slide. So basically, as I've said, they're going to be on their same growth trajectory. There are going to be non-homothetic preferences over the different consumption goods. So as income rises, demand for agricultural goods relative to manufacturers, relative to services, is going to be adjusting. We're going to have capital and labor inputs into each sector, and both factors can move between the sectors. TFP is going to grow at different rates in the three sectors. So as you can see, it's kind of a menu of both supply side and demand side, both non-homotheticity and also these supply side differences are going to come together to produce this growth path. We're going to have a manufactured good. That's the one that can be invested and it can be moved into the two sectors. And then when there's liberalization, it's going to be that manufactured good that can move abroad as capital investment. And we're going to set this up so that all of these underlying preferences in technology are going to be the same in the two regions. And in fact, we're going to calibrate the model using only Block A data. And in fact, we're going to do our best to only use data kind of at the beginning of the sample so that we're like setting this economy off with those initial conditions and then watching the economy go. What the difference for Block B, holding all those parameters the same, but we're going to start Block B with a lower initial capital stock. That's going to allow us to shift that investment hump back. And we're going to have lower labor productivity per unit of capital. And that's going to lower income, and that's going to lead to this delay in structural transformation. So those are the two levers we push to get a slightly different picture in Block B relative to Block A. I want to do a call out to this paper is very much in the spirit of some work that was done by Echevarria quite a long time ago, but we discovered this model and it was like, oh, this is really great. This has got the ingredients we need. Now her model was, she didn't have a kind of a stationary growth path that she went to in the long run equilibrium. She just kind of kicked the model off and let it go. And it was a single country and it wasn't open. So it was a closed economy that kind of grew over time, but it did have these features in it. And so it was a useful place to start. Okay, so this is the optimization problem for one of the blocks. The stuff that's in red is where we depart from the Echevarria setup. So here we have our preferences. So there's separable log preferences for the three goods, but we also have this component that's the non-homothetic component. And this is going to be the part that as income rises, you're going to get some curvature there in preferences for the three goods. And we've got this G term in here. This is kind of a growth term or a parameter that we put in there so that in the long run, the non-homothetic part starts to melt away, and in 1,000 years, that basically plays no role, but it allows us to pin down the long run steady state. That's going to be important because this is going to be an open economy and they're going to be trading bonds. And so we're going to have a non-stationary equilibrium. We have to solve for that bond path and we have to solve for the equilibrium of the two countries to make sure it's all consistent with long run transversality conditions. So we had to use a shooting algorithm to do that. And to do that, we needed to have it end up at some long run stationary level. So that's why that's there. It doesn't really play a role for the time period we're looking at, but it helps us solve the model. Okay, that was a lot of detail about that. The second good is the manufactured good. This is the good that can be consumed or invested. And it's also, this red is indicating this is where we trade in our international bond at the equilibrium world interest rate. This allows for that borrowing and lending with the rest of, with the other block. And we have an adjustment cost in here because we want to slow things down. We don't want there immediately to be this gap in the marginal product of capital and then all this capital moves right away. We also have a services sector, and that's going to be the third good. So you can see the trade is going to happen and the flows are going to happen in the form of the manufactured good, and then the adjustment and structural change will be the relative sizes of services and the agricultural good. We have market clearing for labor. It can go to any of the three sectors. Capital can be allocated to any of the three sectors. And then of course we have the transversality condition for the steady state. So that's the guts of the model. As I said, we're going to calibrate this model so that it looks like block A. We do use some data toward the end of the sample now for the calibration I'm showing you now, but we're working on a version where we're calibrating to the shares at the beginning of the sample, but I didn't have those all done today. In fact, we're trying to get data that go much further back so we can say, you know, we calibrated it to the time period that we're not even looking at, and then we let the model go. So, but for right now, we did look at the shares in 2000 to 2014. Blocks A and B are identical, except that Block A has higher initial capital stock and Block B has less effective labor. And this is going to have Block A be more advanced along the process of structural change. And in fact, we think, and I'm going to try to convince you that this is, when I show you some of the time series figures, that this is kind of reconciles the Roderick view with the Chari-Henry view, that what happens when you open markets is that income changes and countries kind of shift where they are on that path of structural change. So it looks like a delay in development, but it's actually an equilibrium response to having capital reallocated between the two regions. Okay, so the regions are going to be closed up until they integrate. Then when they integrate, they can trade in this capital good. We have adjustment costs. And as I've already said, we have the shooting algorithm. Don't need to go through that again. Okay, so some results. So now this is having kicked off the model and watched these two regions grow. And then we have them liberalize in 1990 and solve the rest of the path after that as integrated economies. So this is Block A. The line is showing you, the dark line is showing you what the model produces as the trajectory. So you can see we get this hump shape in investment that fits through the data. For Block, at the time of liberalization, you could see things, the investment rate ticks down. That's because at that point, capital is flowing out of Block A into Block B, and actually it helps fit the data better by having that point of liberalization. So it kind of pushes that investment rate down. Again, Block B, all we did was take all the parameters for A, and then we said we matched the per capita income. We adjusted for the difference in per capita income and for productivity way back in 1960, and then kick the model off. And you can see it produces a line. It doesn't fit completely through the data, but it's given that we put very little structure actually on Block B, it fits pretty well. And it also at the time of liberalization kind of reaches up to pick up those points at the time when capital flows into Block B. So this is what we're able to get these investment humps out of the data. And then this is my favorite picture because it looks like a little heart shape here. And you can see both blocks A and B together. And you can see we're picking up the fact that we've got this leftward shift in Block A. And you can see the point of liberalization, how it kind of fits better through the points of data at the time of opening. And again, that's endogenous. We had these two economies, I want to be clear. We had these economies grow, and then we got to a point and we said, now it's 1990, open. And depending upon the marginal product of capital, that determined the volume of capital flow, and then that pinned down what happened to investment rates in the two countries. So we didn't calibrate to how much capital flew or changed between the two countries, and we didn't calibrate the opening to when the marginal product of capital was at some particular point. It actually turned out to be the point where it generated this shift in investment in the two regions. This is showing it in terms of time. Here you can see the countries ticking along. It's really the same curves. They're just plotted now against time instead of against income. And you see this tick up at the time of integration and this tick down in Block B. And if we look at those parabolas, what those parabolas look like, again, they both peak at the rate that we saw, essentially what we saw in the data, although Block B peaks higher. Why is that? That's because when you look at the data, it's telling you, oh, there's this big surge in investment and we get this kick up. And so because we don't slow it down enough, I think, we get this big peak that happens in 1990. as opposed to later in the data. But you can see we get a similar difference in per capita income at the peak and a similar difference in time. Here's structural transformation. So the various kinds of dots or triangles and squares and things, that's what's in the data. The dotted lines are the what comes out of the model. You can see the model's smoother than what we see in the data. For block A, it does pick up kind of this hump shape that we see in manufacturing. It overstates, it keeps too much in agriculture, and it goes too quickly into services. So one of the things we're trying is we're seeing whether if we kick the model off with sectoral shares way back in 1940 or so, do we do better? How does the model work then? We'll see. That's work in progress. You can see in block B, it also runs centrally through the data. It's not perfect, but it picks up the general trends in the data. And again, if we take those shaded regions that are 35 years apart, indicating kind of those differences in income, the model generates sectoral shares that are really very similar between blocks A and block B. And that was what we saw also in the data. Here's the volume of capital flows. If you remember, this is what I said was the volume of capital that went from block A to block B. We get a much bigger surge, which is why we get that big kick up in the investment rate. So, we are working on if we slow that down a bit and kind of smooth it out, put some kind of an AR on that to make that a little bit less spiky. But what's encouraging is if you took the integral underneath that curve and the integral underneath this curve over this initial surge of capital flow, it's about the same size. So it's picking up the right volume of capital flow. It's just not getting the timing quite exactly right. But again, just to say, this is endogenous. We didn't feed in a surge in capital flows. We let the model tell us how much capital flow there would be.
Linda? Again,
yeah,
just abusing my position here as a panelist. So,
absolutely.
but in your model, there's no uncertainty, isn't it? So, naturally, in the real world,
absolutely no. In fact, we wanted the most simple, deterministic, long-run growth model. Obviously, there's crises, there's expectations, there's probably bubbles, there's things. So, I guess I should let you finish your question, but I guess
my question is basically that might explain why, basically in type T, you liberalize and everything from here in advance, all the state of the world. So of course, perhaps you're gonna over invest compared with the data where people are more, there's uncertainty about the world. So
for sure. Yeah.
So I don't know.
Yeah, I mean, we could have had uncertainty, but we really deliberately are not feeding in anything stochastic. We're saying this is a growth process that got kicked off, and off these economies go, and they're on their path. And so in that sense, Danny Roderick is right. Liberalization does not change long-run growth rates. We actually don't, there is, a lot of people looked at this and have argued, look, we really didn't see significant changes in growth rates. But we did see changes in levels. We saw changes in investment rates. We saw changes in per capita income. We saw some sectoral change, but we didn't really see changes in growth rates. So that's what this model is it's a completely deterministic, everything was set in time. I mean, I'm not saying it's, fits everything. Obviously, given most of my work has uncertainty in it, I'm a believer in dynamic stochastic equilibrium models. But this one was just like, we could do this simple thing, and it actually explains quite a lot. So that's what we did. All right, so now we're going to use this simple model to think about the welfare gains from capital market liberalization. So, in a one good model, which is where oftentimes these kinds of calculations are done, it's fairly simple. You just track consumption and you say how much did consumption change, and you take the present value of that and convert it in a utility metric, and off you go. Here, it's complicated because we have multiple goods, and we have multiple goods over time, and their relative prices are changing all along that path. So that led us back to our, having to open up our microeconomic textbooks and think about how to do this kind of measure. And of course, theorists have this measure and people use it. We can look at the compensating variation, and we can look at the equivalent variation. So one is an exercise in saying, if you hold post-reform prices constant, how do we think about that? How big is that shift in the utility curve post-liberalization? Or you can hold prices fixed at the pre-reform level and ask, how big is the shift in the indifference curve? So that's essentially the exercise. So you solve the model, you get the whole trajectory of prices and incomes, then you go back and you say, now if I value things using the old prices at that point in time, I should say, and then you take that forward, how does that look? So that's the two exercises we do. I don't know which one, I don't prefer one over the other. They produce answers that are very similar and seem quite sensible. So we did this for the welfare gains from liberalization for Block A and Block B. And we get an answer that I think is in line with what people find from standard kind of growth models, where we haven't affected the growth rate, we've just affected the level. We did a little perturbation. So this is very similar to like work done by Gurenshaw and other people. We find quite small gain for Block A. They gain a little bit because they can now invest in Block B, and they get kind of a permanent increase in consumption due to the interest income on their investment. Block B is the big gainer because the capital comes in, and that really pushes Block B forward on their development path, because Block B is now income has jumped, and now they can move forward and on that path of structural change. So their gains are about 7 times bigger than Block A's gains. But I have to say, it's still really small. It's 0.07% of permanent income. So it's small. If we can ask the question, do you prefer liberalizing earlier or later? And I think this is also consistent with work that's out there. You prefer going earlier, both regions do. Why? Because, it goes back to your standard trade result. Earlier, you have the biggest gaps in the marginal product of capital between the two regions. So you get the biggest investment reallocation and the biggest gains from trade, basically. And if you wait long enough, these economies start looking similar, they're converging to the same path. Essentially, there's nothing left to be gained by being open because they're basically similar in terms of the marginal product of capital. Now, they're not identical in terms of their level of consumption or their level of income, but their, the relative price of the good that's traded, which is capital here, is basically the same. So that's what this says in terms of that phase of initial liberalization. We do another experiment, I should say, and this produces the standard kind of savings investment dynamics that we're all familiar with, that Block A saves more and invests less because they're sending their capital to the other region. Block B says, yay, send me your capital. This means I can actually consume more. So their savings falls and their investment goes up. And here's where you see how it shifts these economies in terms of structural change. This is where that interaction between what's happening with investment, liberalization, and structural change. Look at what's happening to Block A. Block A says, wow, it's really beneficial to have our capital located in Block B. In fact, we should produce more of it so we can export more of it. So they actually take resources out of agriculture and services and put it into production of Block B. If you look at consumption, they actually give up consumption of services and the manufactured good. And they also sacrifice some consumption of agriculture, but the composition of consumption is now more heavily tilted to agriculture than it was before. In other words, by taking capital out, they've shifted back kind of backwards on their path of structural change. And exactly the opposite happens in Block B. Capital comes in and they surge forward by consuming now more of services and manufactured goods, and they consume more of agriculture, but as a percent of the whole bundle, it's somewhat less. So this is how structural transformation is kind of kicking in, and it depends on the level of income, and that income comes with the reallocation of capital. Okay, so that's what happens with that initial phase. I don't think there's any surprises there. The next thing we wanted to ask, though, is this is kind of getting to Roderick's question and other people's questions about out there in the literature. What happens when you liberalize again? So can you be in a bad spot when other waves of liberalization come? So we thought that was kind of interesting. And so the setup we have here is, suppose China became a completely liberalized economy. You could move private capital there and be 100% certain you're getting your marginal product back, no interference from government. It becomes a completely liberalized economy. I know this is not the world we live in right now, but this is a counterfactual or an experiment. China has, right now, tends to be investing in the United States and in other advanced economies, but that is largely affected by policy. I think if China were to liberalize truly, they would need more capital given the amount of labor in China and given its level of income. So what we did was we said, suppose China opens and that the interest rate in China is where the interest rate was when Block B opened. So it's the same opportunity. It's just as where we were when we looked at, oh, we're liberalizing in 1990, here's this opportunity for this high marginal product in Block B. Now we're going to say, okay, blocks A and B, you've been growing along together, the marginal product capital has kind of come down, but now here's this new investment opportunity. It's called China, and it's going to have an interest rate trajectory that follows what Block B was doing in 1990, okay? So that's the experiment here. And now you can see, interestingly, Block A gains a lot, and Block B is kind of meh. It's still bigger than the gains they had with the initial liberalization, but in fact, we have some calibrations where we can make Block B actually lose from liberalization. So what's going on? So we look at what's happening. Block A, if you think about it, if you go back and remember, when they first liberalized, put capital abroad, and now they're earning interest income on that investment. And now comes along another opportunity, and they say, great, yay, another high marginal product, an even higher marginal product opportunity relative to where our capital is now. Let's go invest even more, okay? And what's going to happen is they're going to earn that higher interest income from that capital investment. Very good. What happens in Block B? Oops, I hit my button. Block B, remember, they were a recipient of capital. So they are net debtors. So they are still paying interest payments on having borrowed initially. And depending upon when liberalization happens, if they're sitting on a lot of debt, think about what the world looks like. Interest rates just went up because China has a higher interest rate, a higher marginal product than they're earning. And so the whole world interest rate goes up, including the debt service on their outstanding debt. So when you solve for the new equilibrium, it's not so great to be entering this new wave if you enter it holding debt that you're paying interest on. So that's why Block B has some gains because there's an opportunity to invest, which they do, but it also affects the cost of debt service. And so that is a bad. And depending upon how those two effects balance out, Block B can actually lose. And I'm not going to go through it, the savings investment. And again, it shifts countries along their structural transformation. I think I'm probably exhausting people here. I've been talking for an hour. So I'm going to leave room for questions and just say, our goal here was to set up a pretty simple, stylized model that describes growth, in a global economy that describes structural transformation, that allows for capital market liberalization, and then to see how this wave of liberalization redistributes capital in the world and how that affects the gains from liberalization. So that's what we tried to do. I'm open to comments and suggestions for future things we might do. And I'm gonna stop there.
Thank you so much, Linda. I am not a macro person, but I really enjoy your talk.
Thank you.
When you show the sample of countries at the beginning of the presentation,
Yes.
you have a lot of heterogeneity there.
Yes.
And in fact, if you have chosen, I don't know, the 1930s, some of those countries will flip between the groups. So I was wondering, you said something that you are trying to go further in time.
Yes.
And check whether if you set if you set the initial parameters to an earlier time, things and doesn't change at all. Do you have any insight about that? You said
So
that you haven't fixed that, but maybe you.
Well, I don't, but I'm sure you're thinking of a case in point would be Argentina, right? Which was a wealthy country and then became not such a wealthy country. And, we picked a point when Argentina had already kind of had a fall from grace and wasn't as rich as it was relative to the advanced economies. I think, I don't want to over claim here because like you say, we've abstracted from important things. And I did show you that the investment curve for Chile doesn't, fit our story particularly well in the 1970s. And for sure, we're missing, Argentina also had big negative shocks that, pushed. And also there was like outright policies that affected structural change, right? Like deliberately moved the manufacturing share relative to the agricultural share. Mm-hmm. So I wouldn't really, I don't know if I would take that as a falsification of our model if policy interventions really, deliberately change things. But you're right, we're abstracting from, emerging markets are such a heterogeneous group. I guess I sort of felt like, having worked a lot of my career on the details of those economies, I was kind of shocked that when you kind of average it, on average, it kind of lined up. So maybe, one view of that is I'm doing gross violence to the data and, average, you just reversion to the mean and it doesn't mean anything. That would be, I guess, I'll be my own worst critic. I can say that. On the other hand, we were trying to do something that was very stylized and very long run. But you're right. I think the initial conditions, we probably need to do more robustness just to make sure, how much that affects our story, how we calibrate to those initial starting points. That's fair. That's fair. And of course, we have a big world war there too that really messes up what these data look like.
Rodrigo?
Okay. Hi, Linda. Thank you for the presentation. Very, very nice presentation. There is, I couldn't get what was the transmission mechanism of the model. Because at the end, you have like kind of a exogenous growth model. So anything that you do with like liberalization and what happened really, I think in the data, when you look cross-country data in general, all those cross-country regression, is what you have is really a level effect. You don't have a growth effect. You only have a growth effect in the short run, which is the transition from one level to the other. So I think this is what the model is doing it seems to me, because you have, if I understood well, exogenous increasing productivity in each sector. So what you finally found is what you should expect to find in a model like that, right? Which is just level effect.
I agree. I'm not going to argue with you. I think I would just say we started out looking at these investment humps and trying to make sense of well, how are we going to get a world that produces these two, and can we integrate a world that has those two? That was where we started. And so we started playing around. And I think in the end, we kind of came back to, wow, we can do that without actually having a transmission mechanism for growth. I think we were kind of surprised. And we had a more complicated model to begin with, and we just kept pulling things out. And to me, I mean, I don't know, maybe it'll be impossible to publish the paper because people will say this is just too stylized and too simple. But to me, it was a real learning process of, you can actually understand a lot of what the impact of this, capital flows and these long run growth paths and these investment rates with, as you say, a neoclassical model where there isn't really a transmission back to the growth rate. I think if we put a transmission back to the growth rate, it wouldn't fit the data anymore.
Yeah, well, I actually like, because the model is simple, and I like the view from the neoclassical point of view. So I'm not criticizing the model. I was trying to figure out this, apart from the initial condition that are different, right?
Yeah.
This is the whole thing. I mean, it's
right.
That's it.
I think the other thing, just to say that I didn't really understand until I wrote down the model, is we could have done this with a one sector model, just one good, and then capital flows. I mean, and that would have been like a Garisha Ray or a Garisha, I'm forgetting who the other co-author is. It's terrible, how you blank on these things on the spot. But anyway, these big names in international macro have written down models with one good, and they do openness, and then they look at the gains. It would be in that spirit. What I didn't realize was, and what I find really interesting is this structural change, how capital flows affect income, and then income affects this structural change in a way that doesn't perturb the growth rate, but it moves you back on the path or forward on the path of structural change. I mean, maybe that's obvious to people. It wasn't obvious to me. I'm not, to me, that was kind of interesting. And that interaction of non-homotheticity with because we had a model with just homotheticity, and we had a model with just and it just didn't fit. And then we put the ingredients together, and it was like, ooh, that whole cocktail is kind of a nice framework to play around with.
Yeah, I agree with you that you cannot capture the structural change using those simple one good model, and that's the nice part. And about China, this is the second and last question about China. When did China liberalize the capital inflows? Because it seems to me that China is a huge international investor in the rest of the world, right? So it's true that it has a lot of labor, and you should expect a very high margin of productivity. But when you look at the data, I mean, China is... No.
I said that too fast. They haven't liberalized. This was what if they did? What if they had a new government and suddenly they became a pro-market? No, you're absolutely right. It's totally counterfactual because China invests. It's an outward investor, not taking in investment. So Rodrigo, you're exactly right. I'm glad you clarified that for people. This was and in fact, I'd love to hear other people, if anyone has a suggestion. I mean, the other place where this project started was thinking about waves of liberalization that you see kind of, suddenly the policy world says, oh, we should be doing this, and there's a set of policy reforms. And our question was, if that is really affecting income and structural change, are we at the end of that process? Like, what's left for globalization? I mean, we worry about globalization looking back, but are there still gains from globalization? Like, is there enough kind of the remaining countries that are kind of outside the sphere? And so China was the one that we thought, oh, maybe the final frontier is China, where we get a big disruption of globalization and growth. I mean, I guess India to some extent would be another country that's not in our sample. And there's also lower income Asian countries that aren't in there yet, Vietnam, but anyway, China kind of stuck out as what would be the last big surge, and how would that affect countries if they've already been open?
Yeah, just what you said. I mean, what you just said, I didn't think of this before, but what you just said was I think it's true. It is wave of liberalization. So sometimes countries do not only open financial accounts, but they open to trade. So,
Yep.
so you do the two things, so that then you capture some capital inflows in order to take advantage of those comparative advantages of those countries that they were closed before, and now they are open to trade as well. So it's kind of many things going on at the same time. So it's difficult to disentangle which effect is more important than others. But,
I agree. And in fact, one of my pet peeves sometimes is there's a lot of papers on trade liberalization that ignore that at the same time there was a change in the exchange rate and a financial liberalization that made it possible for firms to, have access to capital. So I'm always the one in the trade seminar going, other things were going on when trade was liberalized. So I guess we're kind of sweeping it all together here. Yeah.
Thank you. Thank you for your presentation.
Well, thank you. I'm delighted to do it.
David Con tenía una pregunta, pero no sé si no tuvo que salir. ¿Se fue?
Salió, sí.
Oh, se enojó. I'm sorry. David Con had a question, but I didn't give him the right to speak until 2 minutes ago, and he's gone.
Oh no, okay.
It was my fault. It was my fault.
Well, he can always email me. I'm happy to.
I will tell him.
Yeah.
So let's see if I have, no, I don't have more questions. Well, thank you so much. Yeah, two more.
Claudia,
that's great. Claudia first and then Luis.
Okay, this is coming from someone that doesn't do trade, Linda, so please be patient. So the question is how much the distance from the main economies will affect the structural transformation, will affect the speed or the end of the share of different sectors in the economy?
I mean, it does, and that's what we're, I think, picking up in the model, that especially that figure that had the two curves coming down, where I said if you liberalize later, it's exactly that if you wait too long, your structural transformation has taken place and you're too similar, like there's not much left to gain. I don't know if that answers your question, or is your question different?
I meant the geographical distance.
Oh, literally that distance. I don't know. I mean, I'm sure distance plays a role in trade. We know it does. It affects trade, measurable trade costs. We haven't thought about that. It must do. I can't think of a paper off the top of my head that suggests that's, I mean, it must. If it delays trade, it probably delays some of the underlying, industrialization, and therefore it'll delay how quickly you get into manufacturing. And so I'm sure it's linked. It's a good question. I don't know.
And maybe you will never do like manufacturing or like high-end manufacturing if you're like very far away from the places where they will buy.
Well, so you're raising a good point. I mean, we're sweeping into manufacturing everything, right? Obviously, countries have a comparative advantage in different kinds of manufactured goods that for sure have different capital labor intensities and probably different underlying growth rates. So we've abstracted, again, I'm going to say, we did a good job because we abstracted from that. But the truth, I mean, like a really rich model, I suppose, would have all that in there. I mean, I think India is a super interesting case, because I think India, given the difficulties of transportation and having been to India, how just non-industrialized it is, it may jump over manufacturing almost completely and go into services because it has a comparative advantage in these digital online kind of telemarketer kind of things. And you see it in India. You see that because of the language and because of the distance barriers, that actually it's comparative advantages may lead it to a very different pattern of structural transformation. We haven't looked at that, but it's worth thinking about.
So I guess it's me, Linda. Your paper remind me of this Krugman and Benavlus 95, which is about globalization and inequality, where they focus on the fall of trade costs. Does your paper say something about inequality within countries or across countries? Is there a story there or? It
doesn't. I mean, I'm sure if Krugman or Roderick were in the audience, they would say, oh, you mischaracterize a lot of our critique of the Washington Consensus. And they're probably right. I mean, part of their critique is that it contributed to increased income inequality. It probably led to maybe more volatility because of capital flows being more easy to move and therefore leading to like more exchange rate crises. And so I probably am setting up a bit of a straw man of their article of their work by saying it's about long run growth. I mean, they do say that too. And they do say that latecomers really miss on the benefits of industrialization, which I don't really think is true. But it probably, I don't have anything to say about whether it contributes to income inequality. It probably doesn't. Our paper just doesn't speak to that. Yeah.
Rodrigo, again?
Yeah. Yes. Sorry, Linda. Again, because you keep explaining things and more questions come to my mind. There is a difference, and I'm sure that you have considered, but is not easy because I don't read the paper, but I'm just looking at the presentation. But there is a difference now between the GDP and the domestic income, right? Yep. Because you have these flows, and then they get the profit and they take away. So maybe that could be a way to explore inequality across region because they're affected, and also within each country, because the flows will go to some sectors and those sectors will be benefits in terms of wages or maybe, I don't know, maybe.
Well, the problem, yeah, I agree with your first point that we're going to get a gap between production, consumption, and of course, net exports by sector. Mm-hmm. We can't really look at wages and capital owners because it's all neoclassical. They all earn the same rate of return.
Right.
In fact, globally, they earn the same rate of return on capital. So probably there's some counterfactual implications for wages there, given that the marginal product of capital is equalized. Unlikely that it kind of passes through to economies that obviously it doesn't. Mm-hmm. That aspect of it I can't really look at, but it probably, if you looked at, how does the consumption basket move? I mean, we get at that a little bit with the equivalent variation and the consumption variation, and we could track that over time. How does the consumption basket move over time? Not with liberalization, but just how does it change over time? That's a good point. We could look at that. Certainly could look at that.
Thank you.
Yeah, I mean, you could think of it like, right, the beginning of time and the end after time, at the beginning and end of sample, if you held prices fixed and asked how much does the indifference curve shift in or out, depending upon what prices you use, that could be interesting.
Well, thank you everyone for all the attention and questions. Linda, we really enjoy your presentation. It's a very nice paper, and if you don't, whenever you have a final draft or an early draft, maybe you can share it with us, because we have several students in our audience that they might want to take a look at it.
Happy to
And
do it.
we might.
I'll send it right away. It's a work in progress,
Okay.
but I can say we do have a draft. So yeah,
That's great.
all right. Well, thank you so much. This was great fun.
And we hope that we will invite you in the future, but for an in-person conference.
Would love to be there. Thank you
Okay,
so much.
you.
Have a great evening.
Bye-bye.
Thank you.
So much.
Bye.
Bye.